XLE or VDE? Which is the best energy sector ETF? I have done a video on both XLE and VDE, but they are 2 years old. You can check out both the videos. I'll put the link right over here. In today's video, we will do a head-to-head comparison of XLE versus VDE for 2024. So all the data that we are going to see will be the 2024 data. I also did a tech sector ETF review. I'll put the link right here as well. Check it out. It's going to be very interesting. We did a similar comparison between XLK and VGT. So similar to that video, I will also give you a quick summary of the 4 criteria I use to select an ETF. Then we will touch upon the profile of the ETFs. We'll look at the performance, the holdings, and then eventually once we decide the winner, I will do a quick technical analysis on that and give you a couple trade ideas on how to add ETFs for small accounts and mid to large size account. And if you enjoyed today's video, make sure to give us a like so that this video can be pushed out to more people. And without further ado, let's dive in. How do I choose an ETF? There are 4 criteria that I generally use in deciding whether I want to get into an ETF or not. Number 1 is asset under management. It simply means that how much money the fund has or the ETF has, which they are managing. The more money they have, which means the more investors are trusting this ETF, and that also helps me drive my decision. The second is, of course, date of inception. So the longer the ETF has been out, which means that they have seen more cycles of ups and downs, and that is very important. A newer ETF which has not seen the lows of the markets may not be the most optimal investment choice for you. So always take this into consideration whenever you plan to invest in an ETF. The third one is expense ratio, and this is very important because a higher expense ratio means that the ETF is actively managed, which basically means that you are going to give away a little bit more gains. So always keep that into consideration because there are ETFs that are passively managed with a low expense ratio, and there are ETFs that are actively managed with a higher expense ratio. The fourth criteria that I use personally is to see whether the price of the ETF is overbought or oversold. This is very important to consider, especially when you are dealing with ETFs or stocks that have run up so much. So especially in the tech sector ETF, because of the massive boom in all the tech stocks, we have seen a massive run across the board. So there are 2 indicators that I would highly recommend that you always watch. Is number 1 is where is the stock price in relation to its 20-day, 50-day and 200-day simple moving average, and number 2, the RSI, which is a relative strength index. We'll cover this in a little bit more detail in the technical analysis, but these are the 4 criteria I use to select an ETF whether I want to invest or trade. If you are just starting out on your investing journey, I would recommend using ETF.com for any research. It provides a lot of good data. Seeking Alpha is another one, Yahoo Finance, Market Watch. There are a ton of tools out there that you can use to aid in your investing journey. Hopping on to the comparison between XLE and VDE. XLE, as the name suggests, it's from State Street Global Advisors, and VDE is Vanguard Energy ETF, which is by Vanguard. At the time of this recording, XLE is trading at $93.41 and VDE is trading at $130.29. The expense ratio, just like XLK and VGT, we see a similar trend here. It's 0.09 for XLE and 0.1 for VDE. The asset under management for XLE is $39 billion and VDE is $8.68 billion. In case of the technology sector ETF, the asset under management between the SPDR fund and the Vanguard funds were pretty even. However, we see a big difference in the AUM in the energy sector as compared to the tech sector. The average daily volume is 1.33 billion for XLE versus 65 million for VDE. Very similar to technology sector ETF, XLE only has 25 stocks, whereas VDE is 116 stocks. Now both are tremendous funds, and you can see that in the performance itself. So within the last 1 year, practically they have tracked itself together. There is not much of a difference in performance. In 1 month, XLE returned 8.14, VDE returned 8.08. So not much of a difference. Similar trend can be seen in 3 months. Year to date, XLE is slightly up at 11.27 versus 10.83 for VDE. 1 year we see a similar trend. It's a percentage difference though, 22.89 versus 23.82. So VDE is actually doing better in 1 year compared to XLE. In terms of 3 years, it's a pretty even game. In terms of 5 years, it's 12.43 versus 11.96, and in 10 years, XLE is at 4.65% versus 3.76%. So if you go back and check the tech sector ETF, you will notice the tech sector generally has returned better performance in 5 to 10 years as compared to an energy sector ETF. Many a times, energy sector is a rotational sector, so money comes in and then rotates out to other industries. So you can take this as an advantage on the next downturn. When it happens, you can get into the energy sector to take advantage for the next boom or the next upswing that you will see in the energy sector. The top 10 holdings for XLE and VDE, we see a similar trend, both at number 1. It's ExxonMobil for both of them. Difference is in the asset allocation percentage. So you have 23.07% in XLE versus 21.49. Chevron is number 2 with a 17.82 versus 14.52. Number 3 is ConocoPhillips. There is a slight difference in percentage of allocation. Number 4 in XLE is EOG Resources, whereas number 4 is Schlumberger NV. In XLE, we have number 5 is at Marathon Petroleum, whereas Marathon Petroleum is at number 6 on the VDE, and at number 5 it's EOG Resources. Schlumberger at number 6 here, Phillips at number 7 for both of them. Pioneer Natural Resources Company, similar at the same level, 3.6 versus 2.8. Valero Energy and Williams Company. When you're comparing these two ETFs from a holding standpoint, you can see the top 10 holdings are exactly the same. The only difference is the percentage they hold within the company itself. Because SPDR funds like XLK or XLE, they both have smaller amount of holdings compared to the Vanguard counterpart. That's why the focus mostly is on the large cap companies as opposed to mid cap and small caps. So depending upon your risk profile, how do you see small companies, small caps, mid caps and large cap, VDE might be a better option for you. The price to earning ratio for XLE is 9.98, whereas 9.67 for VDE. So VDE has a slight edge over here. Price to book is 2.11 versus 2.01, and distribution yield is 3.15 versus 3.01. Next up is dividend. So how does the dividends look like in both these scenarios? So for dividend yield for XLE is 3.15 versus 2.99 in VDE. So you do get a little bit more dividends in XLE. The 4-year average yield is 5.28 versus 3.98. The dividend rate is $2.92 you get trading 12 months, and 3.86 you get on VDE for the entire year. The dividend growth 3-year CAGR is 11.83 versus VDE is 15.84. Dividend growth for 5 years is 7%, but still VDE is leading the pack here. Consecutive years of dividend growth is 0 for both, and dividend frequency is quarterly, so that's not a surprise. Who is the winner between this head to head? There are 4 criteria I use, which I talked about earlier in the video. Number 1 is asset under management, inception date, expense ratio, and the price of the ETF. In terms of the inception date, both are very similar. So one was in 1998, one came out in 2004. They both have seen similar amount of ups and downs in the cycle. Expense ratio, XLE wins, but by a very slight margin. Asset under management, XLE wins hands down. So what it really comes down to is, what can you afford in your account? Can you afford an XLE or can you afford a VDE? That will be the answer for you to decide. For me personally, I would go with an XLE. The reason is because the stock price is a little bit lower than the VDE with very similar advantages, and because if I'm using options, a lower price stock or ETF is better suited as opposed to a higher price stock or ETF. Is this a good time to buy XLE? Since the middle of February, the stock has been on absolute tear. They ended at 93.40 at the time of this recording. There aren't that many red days for this particular ETF. We even had this gap up here right in the middle of March, especially with energy pricing going up. For example, ExxonMobil was trading around the $100, $102, $104 mark. It's currently around, I think, $114, $15 as of today. Now, when we draw the volume profile, between $81 to $86 is where the majority of the volume shelf is, but there is little bit more volume being built in the levels of 90 going all the way to 92.24. So just looking at these levels right now, it does seem that the stock is a little bit detached from reality, especially being on the uptrend, and 20-day moving average is trying to catch up to the stock price. If you zoom out for a second, you will notice that the stock price or the ETF price generally respects the 20-day moving average. The next point that you should consider is the RSI currently is at 76, so the stock or the ETF is really overbought. This is not the time for you to be buying at the top, especially when you have sector ETFs which you know will be pulling back at some point in time. So the best course of action would be, if you want to get yourself involved with the energy sector ETF and you decide to buy XLE, wait for it to pull back to the 20-day moving average, and that's where you can probably initiate your first position. But generally what we do is we try to hedge ourselves by opening options, which is a cash secured put. So let's say you want to purchase XLE 30 days out and the 20-day moving average is about $89.59. So let's say $89.90. So a $90 would only get you 13 cents 30 days out. Not a great premium at these levels because the delta at 90 is 17%. So there's only 17% chance that you are going to get this assigned. However, I do think that it is better to be careful, especially when you see ETFs running so high. And again, this is not Nvidia and that other tech stocks that can have gap ups, can run for months and months. This is energy sector, so you will see the rotation happening at some point in time. So in this case, because the 30-day premiums are not great, I might look at the 60-day or 51-day. At 90, I'm going to get about 63. This will be about 89.37 would be what my cost base is. Again, not getting a very good deal on these ETFs because even at 90, it's only 23 delta. 90 days out, you will get about 1.44, and you can see the delta actually has increased to 30. So on the 30-day time frame, our delta was 17 at 90, but it goes up all the way to 30 90 days out. So it is expected that there's a lot more pressure will be there next 90 days or so. So this is one way that you can open a cash secured put for 90 days out, so about 28 June. And if you get assigned, your cost basis will be $88.66, and I believe that gives you a little bit more downside protection in case the ETFs pulls back to its 20-day moving average in the next 90 days or so. Another option, keep in mind that if you don't want to get assigned, you can always keep rolling and collecting premiums. That is also an option on the table for you. So there you go. That was a head-to-head comparison between XLE and VDE, where I chose XLE as my primary winner because of the asset under management and the current price. Also, I gave you a couple trade ideas for the next 30, 60, 90 days. You can use options to hedge your downside risk. And if you enjoyed today's video, make sure to give us a like, click on subscribe, and ring the bell notification. I will see you next time, investor family, but don't forget to invest for tomorrow.